Welcome to the Property Nomads Podcast. Welcome to Market Macro Madness. We are going to be looking at all the different things that are going on in the world at the moment, how that can affect you, how that can affect property. There's a lot going on with interest rates, mortgage rates, and so forth at the moment. A lot of doom and gloom out there. And I'll hold my hands up. I said on the podcast last year, and I've said this year as well, that we are heading into dark times. With energy rationing potentially coming up, quite literally, we're going to be heading into dark times. And I don't mind a bit of doom and gloom, because I think it's always good to prepare for things, even if they don't happen. To have that preparation is useful. On the podcast before, we have spoken about gold, we've spoken about silver, and I've made it very clear. I'm not an investment advisor. Please do not constitute what I say to you as actual investment advice. All those disclaimers that come with it. I'm just telling you what we're doing in the background in order to protect ourselves. So with all that being said, what's going on with the markets at the moment? So let's start with property. Let's start with mortgages. With interest rates going up, and the reason we have to start with interest rates is all this pandemic stuff and all of that. There's a lot of currency that was printed, and as a result of that, we've then had more currency chasing fewer goods and services. With stimmy checks and furloughs and bits and bobs like that. Now, as a result of that, with too much currency chasing fewer goods and services, or the same level of goods and services, that is going to increase the price. It's economics 101. And you're thinking, Rob, can you just remind me why you're saying currency and not money? Well, money has to be a store of value. A pound coin, a dollar, is not a store of value. If you look at how much a pound has depreciated in the last 100 years, I think it's 90+% that the pound has depreciated. A pound coin, a dollar, yen, whatever it might be, they are not a store of value. The only things that are proven to be a store of value, gold and silver, as Robert Kiyosaki says, and as I say as well, God's money. True money is gold and silver. Say pound coins, etc., are currency. That's why I say currency supply. So going back to furlough and bits and pieces like that, pandemics come in, we've all been locked down, locked in cages, etc., etc., etc. Currency supplies increased. Level of goods and services being produced has either remained the same or decreased. So more currency chasing the same amount of goods. Voila, there you are. Prices increase. Not good. Now, as a result of that, the Bank of England realised that they're in a bit of a pickle. So over time, what have they got to do? Well, modern monetary theory would suggest that you're going to have to ideally inflate away the debt. Nothing wrong with that. As property investors, you and I understand that purchasing a cash flowing asset is beneficial, and inflation will erode away the debt on that asset over time. So there's nothing wrong with inflation from a property investor point of view. Hands up, it's absolutely fantastic. Maybe not at 10 or 11%, granted, as per the latest CPI or CPI figures, but hey ho. So that's what happens. So then you've got inflation. In order to curb inflation, what MMT will advise you to do, or what central banks will try and do, is increase the interest rates in order to try and control inflation and erode it away. Well, okay, in theory, is that going to work? Probably not. But however, what has happened with the Bank of England and other central banks as well, increasing their interest rates, it means that mortgages, depending on what mortgage you're on, mortgage rates have increased. Now, this is where, and I've always said this is where having an idea of macroeconomics is very useful from a property investor's point of view. Because in the last 10, 15 years, if you started in property like we have, we've been used to relatively low rates of interest. Now, of course, if you're buying it in personal name, you might have had 1% mortgage, 2% mortgage, maybe slightly more. In a limited company, you've probably got away with anywhere between 3 and 4% maybe. But of course, now the Bank of England interest rate is increasing, the base rate's increasing. That means the amount that mortgage companies are going to charge start increasing. And of course, this can make a big difference to your portfolio. Why? Well, I'll give you an example. We're refinancing. There's only one property in our portfolio we have not refinanced over time. Our rule, you refinance once, then you leave it. Why refinance once? So you can draw the initial capital back out, hopefully, of the property, and then moving forwards, again, inflation will erode away that debt. I appreciate it's quite technical. I should be doing this on a video or doing at least a whiteboard video of this. Maybe I should start doing whiteboard videos. We'll deal with that later on down the line. So in theory, that's what should happen. Inflation will erode away the debt. So went to our mortgage broker and asked him to speak to a couple of banks, get a valuation done on one of the properties. Came back, property value was great, good for us, good deal for us. Mortgage value, the mortgage interest rate, just over 6%. Crazy. Now, I've not seen anything like that before in our time in our portfolio, because most of our products are on long-term fixed rate deals. Why? Because we can see this happening a few years ago. So we rushed around to get this, to sort out most of our portfolio. This last property was a bit of a straggler. But going on to 6%, what does 6% do? Well, in the grand scheme of things, in our portfolio, it's not going to make a huge difference. We will have a bit of a cash flow hit, granted, but the amount of capital that we're looking to now take out of this property is actually very good for business. We can deploy that finance elsewhere. And most of our portfolio is on 3.5% fixed mortgages for the next 4 or 5 years. We'll deal with that bridge in 4 or 5 years' time. However, if you're a landlord and you've only got a couple of properties and you'll now get into that stage where you are looking to remortgage, well, if you've been used to 2 or 3% rates for the last 5 or 10 years, 15 years maybe, and your rate's now up to 6.5%, maybe even 7%, that could potentially seriously impact your cash flow. And if your portfolio relies on cash flow and you're not employing a capital growth strategy, then the feces in the fan are starting to get a lot closer together, if you catch my drift. And this is what a lot of people are getting at the moment, that they don't like the fact that mortgage rates have gone up. Again, Bank of England base rate on average since 1694 has been 5% there or thereabouts. In the last 15 years, we've been very blessed with very low interest rates. So interest rates are starting to increase and people are starting to now really question, is property the right thing for them? What's going to happen moving forward? Well, Mark Champ from Wolf Financial and we spoke about this at the end of 2021. We both said that interest rates are going to significantly rise this year. And because of the amount of currency creation over the last couple of years, that trend's probably going to happen in 2023 as well. At some point, something's going to break. The bond market, or the gilt market as we would know it, that nearly broke a little while ago. Pensions nearly collapsed here in the UK. So nothing to do with me. I don't have a pension. Property is my pension. Metals are my pension. Just maybe some stocks and shares in mining. They are what I'm looking at the moment. But for you regular, ordinary folk out there, if the pensions market collapses, that will be Armageddon. And that can happen around the world. Chances are it probably will at some point. Everything we're doing at the moment is not sustainable. It hasn't been sustainable for the last few years. It's not sustainable moving forwards. There needs to be, dare I say it, a great reset. But I'm not going to get into my conspiracy thoughts on this episode. That's not what this episode is about. So let's recap, because I've gone off on one, too much coffee this morning. Currency supplies increased. Goods and services that are being produced has either remained the same or decreased because of all these draconian measures imposed by governments around the world. That means that inflation has occurred because there's more currency chasing the same amount of goods or fewer goods and services. Now, as a result of that, CPI is 10+% as we record. Modern monetary theory suggests that in order to try and combat this, you should increase the interest rate. And what we're finding in the property world at the moment is that that's having a serious effect on borrowing. That's also having a serious effect on a lot of landlords and their cash flow positions. Again, this is why we pound the drum on this podcast and say that it's important to understand the macro. Don't just get into property and go, hey, it's all going to be tickety-boo, hunky-dory. You need to understand the macroeconomics behind what's going on as well. This is not going to get any better anytime soon. Definitely not going to get any better anytime soon. So what can you do? What can you do moving forward? Well, from a property point of view, as we've always said, there's always opportunities. Maybe private investors are actually cheaper at the moment. Maybe they're easier to get hold of their funds. If you haven't remortgaged already, should you remortgage? I don't know. You need to speak to your broker on that. Rates are probably going to go up, I think, quite considerably in the next 12 to 18 months until the world economy breaks. What can you do to protect yourself? What if you haven't already got property assets and you're thinking about getting involved in property. Maybe if you can buy cash, maybe that's the best way forward. What can you do outside of property? I'm not here to jump on crypto and bits and pieces like that. You might want to consider looking at Bitcoin. You might want to consider looking at other coins that are out there. Why? A lot of decentralization is probably going to take place over the next few years. So maybe that's worth studying. Metals, gold, silver. Okay, they've not reacted how people think they should have reacted this year. And there's a lot of suppression in the COMEX markets, the paper markets. There's a lot of suppression there. Maybe it's worth looking at metals. Maybe it's worth looking at gold and silver and potentially purchasing them as an insurance policy for when things go really bad. That's what I've started doing in the background, to have that insurance policy. Ultimately, with gold and silver, if they go to the moon, that's great for people that have purchased gold and silver, but that normally means the rest of the world has gone tits up. So a part of me, of course, wants that to happen because I like to profit, but a part of me does realise that, that is also not very good for a lot of other people around the world if that were to happen. But hey ho, I'm a capitalist and I just take my time to study this. So what could you do? You could look at Bitcoin. I'm not saying, again, I'll caveat what I said at the start. Please don't take this as an investment advice. I'm not an IFA, blah, blah, blah. But you could take some spare time to look at Bitcoin. You could take some spare time to look at a couple of other coins that are out there. You could then look at metals. Silver, seriously undervalued, chronically undervalued at the moment, at the time of recording this episode. You might want to have a look at that. Also go back to some old episodes we've done on gold and silver with how to buy, what to do, things to look out for. Other things you could look at doing is, metals we've spoken about. I'm just trying to recap now, a bit of a brain fart now. Crypto. Now, you can also look at property. There's always opportunities out there. Now, whether that is getting in there with a regular buy-to-let, I don't know. With all the recent changes in building regulations and planning permissions, etc., you might find that actually getting involved and doing developments might be the way forward. There's always opportunity. That's the underlying thing to every single podcast we ever do. There's always an opportunity somewhere. So just look for it. Speak to people, network, have a chat, see what's going on. Do what you can. As Robert Kiyosaki says, and as many people say, you ideally want to buy low, sell high. I think we're starting to get into that, bubbling point of the market. And I've said that before. Would I go in and start buying buy-to-lets right now? No, absolutely not. For myself, Aaron, we've got plenty of things that we're looking at in the background. Cash generating strategies, not income generating strategies as such. We're after the lumps of cash. Why? Because when the market corrects and finances tighten, that's going to be a time where you can come in with cash and you're going to be in a much better position to purchase some cash flowing assets moving forward. That's what we're looking at the moment behind the scenes. Other things you could look at as well, stock market, what's going on. Now, I'm not saying let's go in and buy Google and buy Twitter and buy that sort of stuff. From listening to the Dig Deep Mining podcast with Rob Tyson, shout out to that podcast. Also things like Quoth the Raven, George Gammon's Rebel Capitalist show, things like that. There's a lot of space in the mining world at the moment. Mining stocks are, quite a few of them are severely undervalued. They're trading at very low net asset values at the moment. You might want to look at doing some research into them. If you're looking to ride the wave of a market and hold a position for 1 to 5 years, again, that's stuff that I'm doing in my spare time, is looking at that, researching that, making my own investment decisions, trying to, although, for example, there's a lot of investment conferences out there at the moment, although I'm not able to attend them physically in the USA, I like to listen in, I like to get involved with them, I like to listen to a lot of podcasts about this sort of stuff. Macro Voices with Eric Townsend is one. Rebel Capitalist shows another one. Wealthy on. Dig Deep, the mining podcast. Loads of content out there that can help you to connect with very intelligent people. So if you're not able to go out and physically network, you can do an awful lot of background networking by listening to podcast content, by reading books, by doing all of these things. There's always something that you could be doing. Ultimately, what is happening at the moment, there is no quick fix for it. There is no easy fix for it. There's going to be a lot of pain. I'm just being realistic. Please don't get scared by this. There is always something you can do to protect yourself. And if you're looking to protect yourself financially, what could those things be? They could be purchasing metals. They could be purchasing some cryptocurrencies. They could be looking at mining stocks. It's about you taking time to do the research, to understand potential investment opportunities, and to do ultimately what you think is right and what works for you. As I said, I'm not here to offer that advice. I'm not allowed to. But what I'm doing at the moment, and what Aaron and I are doing in the property business, is we are focusing on chunks of cash, because most of our portfolio is on low interest, long-term fixed rate mortgages, because we understood the economics in the last couple of years. So we've prepared for that, with the exception of that one property that I spoke about at the start of the episode. And then in my spare time, on a personal level, I am looking at cryptos, I am looking at trading, I am looking at metals, I'm doing a lot of research, I'm doing a lot of listening, I am looking at mining stocks, and I'm just trying to absorb as much information as I can and creating a battle plan that works for me. That's what I'm doing. You should probably do the same. Ultimately, you have to do what's right for you, given all the information that you have out there. Mark Champ from Wolf Financial will be back with us next week. We're going to be going a bit more deep diving into everything that's going on in the property world as well. So look forward to that. Regarding the travel episodes at the moment, we are World Cup's around the corner. We have Thursday's episode is about the Old Firm Derby, Glasgow Celtic, Glasgow Rangers. We were lucky to go there at the start of the year, absolutely phenomenal. So do check in with the Thursday episodes. As always, leave us a review on iTunes, Stitcher, etc., etc. That really helps to push the podcast as well. And sign up for the newsletter. We're back monthly with a newsletter. Loads of great content in there as well. Go to tpmpodcast.com, I think it is, on the homepage. Scroll down, sign up. You get a couple of goodies there as well. And we look forward to adding content and adding value to you that way. But in a nutshell, there's a lot going on. There's a lot of macro market madness, however you want to disguise it. There's a lot of crazy crap going on. It's not going to get any better anytime soon. And we're going to have to ride out this trough as and when. That might take a few years, but it's going to get better before it gets worse. And that's just being realistic. I don't know what else to say apart from hasta luego. Thank you for listening. Leave us a review, sign up to the newsletter. Thank you for your continued support of the podcast. And we will be back next week with Mark Champ from Wolf Financial.